Hello, students. How are you guys? In this lecture, we will be starting with the investment appraisal techniques. Until now, what we have done, we are now being able to apply some business mathematics knowledge first. Then we go through the relevant cash flows topic, incorporation of tax, capital allowances, working capital, how to inflate the cash flows. Now, in this chapter, we will formally be applying the investment appraisal techniques. Until now, we have applied one technique, that is ARR, and you know the ARR method is basically a profit-based technique. Now it's time to apply the cash-based techniques, for which in the previous lecture we prepared the relevant cash flows. So let's start one by one with the technique. And our first technique would be here, IRR, internal rate of return. It is assumed that it's not actual meaning. Normally it is assumed that this is minimum actual rate of return. Why I am saying it is assumed, this I will discuss later on, then you'll come to know that why it is an assumption, not a reality on single investment. And if you see any investment, if its rate of return is greater than the cost of capital, then we are going to accept this project. If I talk about its pros and cons, advantages, definitely it takes into account the cash-based technique. It accounts for the time value of money. It accounts for the whole life of the project. Cash flows are taken. Easy to understand for the non-financial manager, because it gives the answer in percentage, and anything which is in percentage is more easy to understand for these managers. Then if you have conventional cash flow projects, what are conventional cash flow projects? Conventional cash flow projects are the projects which follow some conventions, that is, the once in a time in a life, there would be capital expenditure, and that will be at year zero. This is conventional cash flow project. And for a single cash flow project, definitely IRR gives you the better result. Then we are not assuming the constant cost of capital being used as discount rate. Because you know that one of the drawbacks of NPV method is that for the year one, it takes the similar discount rate. For year five, it takes the same. Here, it is not the case. We are not using the discount rate here. We are actually finding out the rate which gives us the NPV of zero. This is called break-even NPV. This is called break-even NPV. Break-even NPV means there at which NPV would be 0. Then we have number of drawbacks. First of all, if you have multiple investments in project, then IRR will be complex to calculate. Because as I told you earlier, that IRR is of investment, not of a project. But if you have multiple IRRs, then how you would be able to calculate the return of the project? In this case, definitely NPV method is preferable. Similarly, mutually exclusive projects, in those cases, again, you have to choose between NPV. You do not rely on IRR. There is a conflict of interest between managers and the shareholders because you are taking the project on the basis of percentage, while the manager, the shareholders wants the wealth maximization. And simply how you calculate it, let's have an example. Let's say if you have initial investment of 1,000 and you are given with the cash flows 1, 2, 3, 400, 600, let's say 300. Assume 10% cost of capital, 0, 1, 2, 3. In year 0, you have an investment of 1,000, 400, 600, 300. Take cost of capital as a first discount factor. Remember, you want a discount rate at which the NPV would be positive. 0.91, 0.826, 0.75. So if you multiply it, 400 into 0.91, 364, it is 495, 285. So this gives you the NPV of positive 84. Now let's have another discount rate. Let's increase the discount rate because now the increase rate will give you the negative NPV. Let's assume it 20%. 1, 0.83, 0.67, 0.51. Here we have 1,000 negative. 400 into 0.83. I am just assuming, okay? This is 325, 600 into 0.6, 264. And here we have 152. So NPV of almost 260 negative. So now put it in IRR formula here. 10% plus what was the NPV at that point? 84 plus add both the NPVs into difference of percentages 10%. It is 1 by 4 almost. Let's assume 13%. So IRR is greater than cost of capital. So on the basis of this, we will take this project. But there are certain difficulties and problems with IRR. For the overcoming of those problems, we have to calculate modified IRR, for which the formula will be given to you in exam: PVR divided by PVI 1 by n into 1 plus RE minus 1, where PVR is present value of return phase, means 1 to 3 years cash flows present value of investment phase, initial investment. RE is the cost of capital. If you see the above example, we have NPV at 10%, 84. This means actually, if I add these three, it is almost 1084. So return phase NPV is 1084. Initial investment value is 1000. One by 3 into discount rate is 10% minus 1. So this is almost equals to 13%. Again, criteria is same, that any project whose mirror is greater than cost of capital is acceptable to you guys. Let's have another example. Initial investment is 20,000. Discount rate assuming 8%. Return phase given to you 1, 2, 3, 4. Cash flows 8,000, 12,000, 4,000, 2,000. Discounted at 8%, 0.926, 0.857, 794, 735. Let's multiply it. It is 7408, 10284, 3176 and 1470. So we have a present value of return phase 22338. Now put the values in mirror formula. 22338 divided by initial investment was 20,000. 1 by 3, no, here n is 4, into discount rate 1.08 minus 1. So this is equivalent to 11%. Yes, here we have a mirror greater than cost of capital, because cost of capital was 8%. So this project is acceptable for us. Now, what is the difference between IRR and mirror? The difference is between the assumptions. What assumptions you are taking? IRR is basically often mistakenly assumed to be measure of return from project, which is wrong. This is what I told you earlier, that normally this is taken as the return from the project, but it is not. What is IRR? IRR only represents from return from project if the funds surplus can be reinvested at IRR for the duration of project. Okay, so this means in year one, if you have a cash flow of 100, this 100 can be invested for further 3 years at IRR. This is the assumption of IRR, which is wrong, because practically it is not possible to earn two IRR on the same cash flows. For example, if you have a project, it is generating a return of 100, then you are assuming that this 100 will be reinvested again in the same project and will give you the same return of IRR. So practically, it does not hold true. For that purpose, we have to see what are the mirror assumptions. Mirror assumptions are that cash surplus which you have of any year are reinvested at firm's cost of capital. So that is why mirror is considered preferable over IRR. Now this is practically, it looks more practical approach. Why? Because if you invest any cash flow at firm's cost of capital, this means that you are just saving the time value of money loss. You will not be able to earn any return, because you know, if you invest at cost of capital, this will give you the NPV negative in NPV 0. So practically it holds true. This means if you have a surplus cash funds in year one, you can invest it at the return which will give you NPV 0. Now practically this is possible, but the approach of IRR, it does not hold true in practical life in your projects. Okay, so now let's move to the other techniques now. Now we have three techniques: payback period versus discounted payback period versus duration. Payback period, you know about it, is simply giving you the time about the recovery of investment. It's recovery period of investment. It accounts for the uncertainty, because in any uncertain environment, investor will definitely go for payback period for those projects whose payback period will be less. And it is, you can say, the most usable technique amongst all investment appraisal, because it is applicable, it is simple to apply. For example, if you take the same example, in year 0, you invested 20,000. In year 1, you have 8,000, you are left with 12,000. In year 2, you have 12,000. It means this is the period. So your traditional payback period is 2 years. Now, the major problem with the traditional payback period is two major defaults here, two major drawbacks. Number one, it is ignoring the time value of money. Number two, it ignores the terminal cash flows. What are the terminal cash flows? The cash flows at the end of the project. Maybe, for example, if you have two projects, one has a payback period 2 years, other has a payback period 3 years. Maybe its terminal cash flows will be negative, but its terminal cash flows will be positive. But you will take the A project because its payback period is lesser. So that might be that you at the end will be losing your money because this project has a higher negative terminal cash flows. On the other hand, the project B, which has although higher payback period, but it has one more advantage that it has higher terminal cash flow, is ignored. So these are the two drawbacks of traditional payback period. Now let us overcome these problems. To overcome those problems, we have discounted payback period. Discounted payback period ignores, okay, it accounts for the time value of money. So one problem is resolved, but still the problem of terminal cash flows is not resolved. Here you are using the discounted cash flows. Here you will use the discounted cash flows. For example, same example, consider in year 0 you invested 20,000. In year 1, what amount you recovered? 7408. You are left with 12592. In year 2, the cash flow's present value is 10284. So now you are left with 2308. And in year 3, you are in positive. So this means your discounted payback period is between second and third year. And you can calculate accurately the amount, the number of months here as well. How you can, in the third year, what was the amount of the, it was present value 3176. 3176. So 3176 is the cash flow of 12 months. This gives you per month 260 per month. Now by the end of 2 years, we need 2308 to arrive at 0. 2308 divided by 260, it is almost 8 months. So the payback period discounted is 2 years and 8 months. Now the third technique here is duration. Duration, it is calculated by Macaulay. So it is sometimes referred to as Macaulay duration. I'll give you the detail about it, but first of all, let us learn how to calculate the duration. Here, you have to take the cash flows 1, 2, 3, 8,000, 12,000, 4,000 and 2,000. Now discount it at 8%. You have a present value 740810284317 3176 and 1470. If we add them all, this is present value of return phase 22238. Now, what you have to do here, you have to take the sum of multiples of return phase. This is year 1, so multiply the present value of year 1 with 1. This is year 2, multiply present value of year 2 with 2. Multiply it with 3, 4. 7408, just multiply it with 2. You have 2056895285884. Just add them. The sum of present value of return phase from 1 to 4 is 43384. What was the present value of return phase? We already have calculated it, 22238. So now put it in the equation of Macaulay duration. It is sum divided by present value of return phase 22238, 1.94 years. So definitely the project which gives the lower Macaulay duration is preferable. From Macaulay duration, we can also find out modified duration. How we can find it? Just divide Macaulay duration divided by 1 plus RE. Macaulay duration 1.94 divided by 1.08. So this is 1.796%. Always remember the modified answer, the Macaulay duration answer will be in years, while modified duration answer will be in percentage. So this modified duration is basically suggesting us the price sensitivity of project or any, let's say if you are talking about duration of bond, etc. This means that if any project has higher modified duration, its sensitivity will be higher. And what is the meaning of sensitivity higher means? It means there will be greater fluctuation in the returns. And you know, in a project where we have greater fluctuation in the return are considered to be more risky investment. Okay. Normally, the duration is used mostly for the bonds. When we compare the different bonds, we use the technique duration. Now you should know the difference between duration and discounted payback period. Discounted payback period. This basically is suggesting the time required to recover the initial investment if we take time value of money into account. This is discounted payback period. Definitely, the shorter discounted payback period, they are preferable. On the other hand, duration means average time to recover present value of project if cash flows are discounted at cost of capital. This means there is a difference between duration and discounted payback. Discounted payback tells us the time period in which we will be able to recover our investment, the initial investment, while duration tells us the time period in which we will be able to recover the present value of project. This is the difference. Now, if you see, duration overcomes the two problems of payback period. Number one, it is accounting for time value of money, and the cash flows of whole life are now in consideration. We are now taking the terminal cash flows into consideration. So this means that we have basically taken the overcoming the problems of payback period. Next, last technique, but not the least, NPV method. Net present value method, always remember, use real cash flows and real discount rate. Real cash flows means uninflated cash flows. And real discount rate means real uninflated. But if you use the money cash flows are often called nominal cash flows. They are inflated cash flows. Always use nominal or money discount rate. Nominal discount rate or money discount rate means inflated discount rate. There is an equation, Fisher effect equation. 1 plus n equals 1 plus r into 1 plus I, where n is the nominal discount rate, R is the real, and I is the inflation. This is the formula to convert real into nominal and nominal into real. When we talk about NPV method, it accounts for time value of money. It accounts for the whole life cash flows. Number three, it can be used for unconventional cash flows as well, cash flow projects. This technique is used for where you have a situation of a mutually exclusive projects, then conflict of interest here is resolved, because you will take the project which will give you the higher NPV, and this is the objective of the shareholders. But on the other hand, definitely we have some drawbacks. The first drawback is we use the assumptions that constant discount rate assumption. We assume that discount rate will remain constant over the period. Number two, very complicated. And all of the cash flow estimation problems are also the drawbacks of NPV method. In the last, let us discuss about capital rationing situation. Capital rationing situation. What is capital rationing? When you have limited capital supply, but you have number of projects in your kitty you can do. So in this case, you have to invest wisely so that the investment will give you maximum return. This is called optimum investment plan. Optimum investment plan is basically the plan which maximizes your returns. Here we have different cases. If we have single period capital rationing, it means that capital rationing is for a single period and projects are divisible. The first step would be you will calculate the NPV of different projects. Second step would be you will calculate profitability index. The formula would be NPV divided by initial investment. Profitability index is for every $1 investment, how much NPV you are getting. If it is 0.3, this means for every $1 investment, you are going to have 0.3 of NPV. Number three, rank the project. The project with the higher PI will rank first, and then so on. And if you have indivisible projects, then in first step you will calculate the NPV of projects. Then you will make the combination of project which will give you the maximum NPV. So this was basically a bit easier chapter, almost a revision of F7, but it is important one, like discounted payback, like mirror, like duration. You should know about it. Maybe you have a question from here. So in the next class, we will start with the WACC calculation. Main topic is WACC calculation. Then we will calculate NPV, and then we will move towards APV calculation. Okay, so take care.